Hey, this is Awais with EminiPlayer.net, and this is a recap for Tuesday, June 3rd. So heading into the open, we were using the 1914 to 1916 half area as the bull-bear zone to establish our short-term directional bias. Overall, the bias was very neutral heading into the open, and we were open to a move in either direction. In the event that the market held above 14 to 16 half and then broke above 18 half to 19, it'd be pretty likely that we would go up and fill the gap and test the 2175 to 2375 zone. That area can still attract responsive sellers on first test, but if we start balancing above 19, then there's potential that we could go up to the all-time high and potentially even higher. In the event of a break below 14, we were looking for a move down to 08 to 10 and potentially 1903 to 05. So really off the open, that 1914 to 1916 half area was very key, and it was going to help us determine which side was in control. Since ES was opening right near that support, we talked about how buyers could still be active near that support zone off the open and go for a gap fill type idea. So that was in play as well. But overall, the bias was very neutral because we are simply trading within a very narrow range and simply balancing within a range. Bigger picture, we know that buyers were in control, but short term, we've seen a lot of weakness in the other markets, specifically the Russell in TF. So that was just a warning sign from the previous session and even in the overnight session heading into the open. So that being said, let's jump into the charts. So right off the open, ES establishes the opening range basically 17 to 19. And if we take a look at the internals, we can see that the advanced decline line starts off on a pretty negative note, stabilizes a bit after the opening range. But off the open, we're seeing some pretty negative values, about minus 300 on the S&P advanced decline, below minus 1,000 on the NYSE, and pretty negative on the Russell, near minus 1,000 as well. NYSE tick below zero on the open, but then starts heading back up. But not exactly a context that gives you a lot of confidence in buying this market either. So as far as the trade setup off the open goes, once ES slams down and can't quite even get to the micro bull bear zone despite all the negative internals and the tick, and then makes a new swing high, that's where we know now that short term there is some strength in this market, right? That's what was discussed in the trade plan, that if the bull bear zone holds and then we take out 18 half to 19, that would be an indication that we're heading up to 2175 to the gap fill and testing the initial resistance zone. So from a market direction perspective, once we broke above 19, the short-term control was on the buy side. So technically, this could be considered a long setup, but the reward to risk is not quite there. If you're buying 18 half, your stop has to be at the very minimum 16 at the overnight low and below that 1675 morning low. So you want to be at the very minimum below all that stuff. So 16 would be the right place to put your stop, or even one or two ticks below it. But let's say this is a momentum idea and you're not expecting 17 to really break at this point, right? This is going to be a significant low now. So even with that, you still have your stop at roughly 16 half, or 16, so 2 to 2.5 point stop. And on the upside, given how weak the internals were, the gap fill was the target, 2175. So there's really not a whole lot in that trade, right? And that happens a lot of times intraday, and especially in these range-bound, low-volume markets where we can identify the direction where the market is going, and it's a pretty high probability target. But the only problem is that the reward to risk is not quite that good, and when the volume's light and the opportunities are not really that abundant, then you want to pull back and be a bit more selective. And for that reason, I chose not to buy the market over here, even though I saw the trade setup in real time and figured this would go up to gap fill. Given how weak the internals were and given how wide the stop had to be, this is a setup that I personally filtered out based on the type of reward to risk that I look for. But as far as market direction goes, once this swing high gets taken out, we take 19. At that point, short term, we are probably going to go up to the gap fill. And that idea plays up here. We go up, tag the gap. Now, given the weak internals, you can see that even though ES filled the gap, the NYSE AD line is still around minus 200, minus 300, still holding below zero. S&P AD never even reached the zero level, and Russell is also below zero. And on the NYSE tick, we're not really getting a whole lot of upside momentum. You can see that, the first time we head up over here towards 21, we push a plus 547 tick, we make a higher high in price and a lower high on the tick, only a 497 this time. So technically a negative divergence on the NYSE tick. And given the fact that the internals were still negative and this was not a very strong market, right? Or at least not a market where it could push to a new all-time high in a straight line. It was a safer setup, in my opinion, to short the initial resistance zone and look for a pullback rather than buy any of these aggressive prices. You can see that as ES balances up at the zone near 2175, the tick actually makes a pretty decent low over here, minus 800, right? So on the upside, we're only seeing about plus 500 to 550 on the tick, but on the downside, when it comes down, we get a minus 800 tick reading. And then when it goes back up, it starts failing at zero. These are all signs that there's not really any momentum to the upside, and there could be a pullback in play here. So to me, that was a safer setup. That's where you can get in at 22, put your stop above the zone at 24, 2-point stop, and that way even a modest pullback to 18 gives you a 2-to-1 reward to risk. And that's really the key metric that we look for, the key filter when we're taking trades is what's the reward to risk. It's not just about identifying the high odds scenario or high probability setups, but we want to take setups where even if it fails, we don't have to be right 80 or 90% of the time to make money. When you're shooting for 2-to-1 reward to risk, even a 50% win rate will get you a positive expectancy and a winning strategy. So shorting 22, targeting at least a pullback into the opening range, and potentially the bull bear zone down here, IB low, right? That's the extended target, but the main target on the downside is really 18. So it's not a huge target, but given how light the volume is, and the recent ranges have been quite narrow, we're not shooting for big targets anyway. If you can get 4 to 6 points with a 2-point stop, that's still a 2 to 3 hour setup, which is very good. So on the downside, this negative divergence plays out. We get a push down to 18 over here, and followed by a little bit more balancing activity. And even this area over here around 19.5 is a potential short setup for re-entry. It is a little bit more aggressive because it's right at the midpoint VWAP, and in a balanced market or a balanced session, that could be a chop zone. So it's a higher risk setup with less reward to risk. But given that tick is holding below zero, it's pretty likely we're going to make another low and test the opening range low at 17, 1675 IB low, and then we have the bull bear zone 14 to 16.5, which is really the key area. So we get this continuation down into the bull bear zone. 16.5 ends up holding to the tick. We get a pretty decent tick reading down here, minus 925. And in a balanced market, when you're getting that decent momentum in your direction, if you're short, then that's usually a good time to cover, especially given that we're in an overall uptrend. So a pretty good target area down here, somewhere between 16 to 17. Right over here is a target on the downside. And because everything was looking very bearish in real time, I didn't trade this on the long side. Even though trade location is very good, 16.5, it's the bull bear zone, just in real time, the market was shaping up to be quite bearish, and there was a chance that we could break the overnight low and head a little bit lower before finding buyers. The range on the day was still pretty narrow, and we could have extended it to the downside. And for that reason, I chose not to buy the market down here. Now, as far as the buy setup goes, once you see this, minus 1,000 tick over here, minus 925 tick over here, and the market can't go any lower, that's a good indication that now the downside could be done, right? It's a very similar idea to what I talked about at the beginning of the video at the opening range, where we tried pushing lower on high momentum and couldn't really go, and then we made a new swing high. It's a very similar idea over here that once you try pushing on a minus 900 tick and then you start heading right back up and you trace this entire move, right? That tells you that there's not a whole lot of weakness left in this market, and now we could be heading higher. Personally, I didn't trade this idea because again, it's in the middle of the range. It's a potential chop zone, but I just want to cover the trade setup for anyone who is looking to be a little bit more active on the day time frame. So the idea is, you push lower on a high tick, decent volume, can't push any lower than 16.5. It's a very key zone, and then we reverse the entire little move on the smaller time frames. At this point, anyone who shorted the area over here is going to be in a losing position, right? As soon as we start pushing higher, and there can be just even a short-term stop run back up to the IB high. And given that we're simply bouncing in a range, that's a pretty normal outcome on this kind of setup. So as far as buying the market goes, I don't think 16.5. I mean, you probably wouldn't have even been filled. Only 211 contracts traded there, and buying it higher required a wider stop, so that didn't make sense. But once you get this reversal in momentum, now at least your stop idea is very defined, right? You can simply put your stop at the low, at 16.5, if you want to take this trade, and look for a move up to the IB high and potentially higher. Because usually, when we make this type of low and then reject it, we're not just going to go back up to the IB high and then just reject it again, come back down. Typically, we'll now have to go higher to find sellers. And given that the overall market has been bullish and we are in an uptrend, usually this is how it'll play out. It will go a little bit higher to find sellers now. It's not just going to reject right where it did the last time around. Similar to even on the downside, right? It went a little bit lower and then rejected. So once we knew that this was not going any lower, then there's a potential long idea here. Again, the reward to risk is not very good because if you're buying 19, your stop does have to be at 16 or 16.5. So roughly 2.5 to 3 points on your stop loss. And on the upside, you're targeting a marginal high because this is not a very high volume environment and the ranges are not very wide. So it's roughly a 1 to 1.5 R type setup. If you're getting it at 19, you're looking to take profit by roughly 22.5, 23. Maybe it'll go a little bit higher, but then there's additional, probability of just some chop at initial resistance. So you have to take that into account. So the target is not really that wide, right? It's about 4 points, and your stop is roughly 2.5 to 3. So it's a little bit over 1 R, which isn't terrible. Those are still setups that have decent edge, but they're not ideal. The ideal setups are when you're getting at least 2 times your risk or more. Then, those are setups you don't want to miss. This one, since the reward to risk is not ideal, you can skip it and, not really get involved because there could be some more chop here before it finally makes the move. But, overall, we still held that 14 to 16.5 area. If we look at the daily profile chart, we can see that we're just bouncing in a range. And overall, we're still building value higher, and the buyers are still holding this market together pretty well. NQ went back up to 37.35 today and held up pretty well throughout the session. Looking at TF, it made a new low, came down to 16, but still closed above that 20 to 22 key HVN. So right now the buyers are still pretty active in this market, and even though short term there were some signs of weakness, those have all resolved with all the markets closing at pretty high prices short term. So right now the way that this is set up, we can see that we've established this trading range 14 to 24, but given where we're establishing a lot of volume and where a lot of trade is taking place, so far this is shaping up to be a balanced market followed by a breakout to the upside. The uptrend is still intact, and overnight, if we can hold above the 1875 to 2175 roughly, if we can hold above that area, that's support in the overnight session, and holding above it would leave buyers in control, and we can get a push up to a new all-time high heading into tomorrow. We also have several econ reports out tomorrow, and they can serve as a catalyst for a directional move. So we are looking for a directional move now. The market has coiled, it's bouncing in a range, it's stuck in a narrow range. Typically, this will resolve with a nice directional move, and that's really the next trade, the bigger trade that we're looking for now. So overnight, if we can hold above 21.75 ideally, then we are set for an upside breakout. On the downside, we still have that key support at 14 to 16.5, and if that area goes, then we can get a pullback down to the 03 to 05 area. But by default, we're still giving more edge to the buyers, and this market is still shaping up to be a breakout type market where we're simply balancing in a range, resting for a bit, and now if we can hold overnight, we can get a breakout tomorrow. So let's see if the buyers can hold it up pretty well in the overnight session, and I'll update you in the morning.